Last month, you probably got paid. And if you're like most people, you looked at that number, did a quick calculation in your head, and felt off. Like something didn't add up. You're making more money than you were 3 years ago, maybe significantly more. But somehow, groceries still feel expensive. Rent still feels impossible. A vacation still feels like a luxury you need to plan 6 months for. You're not imagining it. And no, this is not a video telling you to cut your coffee or track your spending. This is a video about a mechanism, a system, something that was built into the economy long before you started working, that quietly, mathematically, guarantees that your paycheck will always feel like it's shrinking, even when the number on it is going up. And the uncomfortable part? Most people will spend their entire working lives never understanding what's actually happening to their money. Let's fix that. Here's why this conversation is urgent. Between 2020 and 2024, wages in most developed economies went up. In the United States, average hourly earnings rose by roughly 20% over that period. That sounds great on paper. Workers got raises. Minimum wages were hiked in several states. Companies were competing for talent. But here's what also happened. The cost of living rose by nearly the same amount. In some categories, more. So people were earning more, spending more, and somehow saving less. And when you talk to economists about this, they nod and say things like real wages and purchasing power and inflation-adjusted income, and most people's eyes glaze over. But those terms are pointing at something.
Let's start with a simple number. Say you earn $50,000 a year. Over 5 years, your employer gives you modest raises, 2-3% per year. By year 5, you're earning somewhere around $55,000. You've been rewarded, you've grown, the number went up. But here's what happened in that same 5 years. Inflation averaged around 4% annually. That means the purchasing power of $1 in year 1 is now worth roughly 83 cents by year 5. Your $55,000 in year 5 can buy roughly what $46,000 could buy in year 1. You got a raise, and you took a pay cut at the same time. This is what economists call the difference between nominal wages and real wages. Nominal is the number on your paycheck. Real is what that number can actually buy. And for most of the last several years, nominal wages have gone up while real wages have quietly gone sideways or down. But that's just the surface layer. There's something underneath that most explainer videos don't talk about.
Here's where it gets interesting. Inflation is not uniform. It doesn't hit everything equally. And this is the part that the average salary conversation completely ignores. The things that went up the most in the last decade are not optional expenses. They are the non-negotiables of modern life. Housing, up over 60% in many major markets since 2015. Health insurance premiums, up nearly 40% in the same period. Education, childcare, energy. These are not luxuries. These are the baseline costs of existing as a functioning adult in a modern economy. Meanwhile, the things that got cheaper? Televisions, clothes made overseas, consumer electronics, things you buy once or twice, not things you pay for every month. So when the government reports that inflation is under control at 3%, that 3% is an average. It's blending a world where your rent went up 12% with a world where your flat-screen TV got 20% cheaper. And the average looks fine, but your bank account doesn't feel fine because you don't live in an average. You live in your specific, actual life. This is called the substitution bias in how inflation is measured, and economists debate it constantly. But for most working people, it simply means the official inflation number is almost always lower than what you personally experience. And there's one more layer. Taxes. When you get a raise, even a raise that barely keeps up with inflation, you often move into a higher tax bracket. Not dramatically, but slightly, which means a portion of your raise immediately disappears into a higher marginal rate. You earned more?
Here's the irony that nobody in a corporate town hall will ever say out loud. Companies will announce record profits. They will post about employee compensation transparency.
They will tell you in the all-hands meeting that people are their greatest asset. And in the same year, they will offer raises that, after inflation and taxes, leave you mathematically poorer than you were 12 months ago. And the framing will be, we gave you a raise. Technically true, functionally misleading. The Federal Reserve, central banks, most governments, they have an official inflation target of around 2% per year. This is not an accident or a failure. This is the goal. A small, steady amount of inflation is considered healthy for an economy. It encourages spending. It discourages hoarding cash. It keeps the wheels turning. But what it also does, quietly by design, is gradually erode the value of savings and fixed incomes over time. If inflation runs at 2% for 30 years, a dollar today is worth roughly 55 cents at the end of those 30 years. The system is not broken. This is the system working exactly as intended. The question is, who designed it and who benefits? The people who benefit from inflation are people who own assets, real estate, stocks, businesses, things that rise in price when money becomes worth less. The people who don't benefit are people whose primary asset is their labor, their time, their salary. Because a salary is just a number. It doesn't automatically adjust. It doesn't compound. It doesn't go up when the asset next to it goes up. It just sits there, getting negotiated